I'm doing well. We are. I just got a message from Krok. It's just going to be the two of us tonight
Oh,
because
okay.
he's out on what you might call maternity leave.
Oh, really?
He has this little girl, so incidents pop up now and again where last minute he's got to go take care of it.
Yeah,
So
I remember.
I envy him. So my youngest is now 18, almost 18.
Okay.
About she's getting, stress has come down a little bit because she's finally gotten quite a few college acceptances. She's
Oh,
been
nice.
very stressed about, but I think once you get a few of them, you're like, okay, well, I'm going to college. So it's just which one at this point.
Yeah.
So,
Oh, congratulations. That's
she's
great.
calmed down,
Yeah.
but yeah, I definitely miss the small ones. Little
Yeah.
different
Yeah.
experience. So.
We've got three girls, but they're 25,
Uh,
28, and 29, or no, 20,
nice.
26, 26, 28, and 29. Youngest one just ran a marathon.
Uh, uh.
Yeah.
Well, I laugh because I know there's a Jimmy Kimmel video where he goes around and he asks all the fathers if they could name their daughters or sons' birthdays, best friend, and teacher, and every dad is like lost, and every mom could spit it out. So it
Yeah.
sounds like the older you get, that doesn't change. You can still
Yeah,
going,
exactly.
and it is frustrating because they get older every year,
Yeah.
so it's hard
No,
to
exactly.
keep track of those. So,
Yeah.
yeah,
Where are you based, Joe?
it's a bit tough. I'm out of Austin,
Oh, okay.
Texas.
Yeah. We go
And
to Fort Worth every year. My wife's brother lives there.
in actual Fort Worth,
In Fort
or
Worth, yeah.
nice.
Yeah.
Yeah,
I love it.
yeah. Yeah, Fort Worth and Dallas have basically just. I mean, people don't realize because you say the Dallas Fort Worth, but there's an hour apart between the two.
Yes.
They're just such a megaplex that it's one big city, and Austin and San Antonio are becoming that. Soon it's going to be San Austinonio
Is that right?
because you know when I've been here, we're pushing 20 years. I've been in Austin, and you used to be able to drive from Austin to San Antonio, and you would see cattle and pastures, and now it's nothing. It's city and stores the entire drive down. So
All
not much to.
progress, Joe.
Yeah, I guess. Let me kick us off here. Welcome to the conversation where we unpack the wild, interconnected chaos shaping our world, including the population's decline and all the reasons for it. Your hosts, Joe Edgar and Ethan Krok, although Ethan's out for the night. But our guest today is Paul Mussen, author of Capital Offense, brings 30 years of investment expertise, including leading McKinsey Investments Ivy funds, founder of Paddington Capital Management and Political Economy blog. He exposes economic flaws and pushes for reform. That his website, Paddington Capital MGMTmanagement.com. Really appreciate you joining us today, Paul. And I said that right, Paul Mussen.
Bustin', very good. Yeah. The
Perfect.
minority get it
Perfect.
right. It's usually Mousson or Mousson or something like
Uh-huh.
that.
Well, I could go with that. I could go with that. It actually sounds better as a Canadian if you go Mousson.
Well,
See,
I grew
that's
up in Quebec, which is French speaking, so it was always Paul Mousson.
ah. Now I did read you were out of Wales, so you went from Wales to Quebec.
Yeah, so I was born in Wales, and my family moved to Montreal, 1965. So just looking for work, and
That was your father, I assume.
yeah, that was my dad. So he was an accountant. He ended up being an accountant for RCA Victor, an
Oh.
old company. And yeah, I grew up in Montreal, place to grow up, but I wasn't
You
fluently
speak French?
bilingual. No. So that's
Ah, gotcha,
no. I mean,
gotcha.
despite taking French, every year in school, and it was a weird thing then. In 1973, my parents wanted to send me to French immersion school, but because I was not born in Canada, I wasn't allowed to go. And then when the separate got into power in 1976, it all switched around. Where if you weren't born in Canada, you had no choice; you had to go to French school, which would have been really good for me. But anyways, it's my own fault.
I see.
Yeah.
You missed both ends of that policy. Hmm. And
So
now, so your father's an accountant out of Wales. I mean, how old were you?
I
You were just
was,
born in
yeah, I was
in
born in
England, or
61, so I was almost 4 when we moved to Montreal.
gotcha,
Yeah, but yeah, I
gotcha.
grew
So
up
you don't
along,
remember too much of the.
right?
I was about to make a joke about England, but go ahead. So you moved to Canada. You're about 4.
Yeah,
Quebec. How long were you in Quebec before you moved
yeah.
to
So I grew up there, and then,
Toronto? Right?
well, 1990, I moved
Ah,
to Toronto, and just looking for work. And yeah, I was literally sleeping on the hardwood floor of a bachelor apartment. And my first job
yeah,
was
nice.
in a video store working nights, and I was 29 years old. That's how I got my start in Toronto.
Oh, we skipped a lot. So you're already 29. So wait, how long were you in Quebec?
Well, 65 to 1990. So what's that,
Yeah.
25
Oh, so
years?
you really did grow up there,
Oh, yeah.
and you don't speak a word of French.
Well, I
Yeah,
do. I
you missed
speak
the
some,
policy,
but
and
not enough,
okay,
I used to work in
okay,
coffee shops, and I had enough French to,
gotcha.
people are ordering toast with peanut butter or something,
Right,
but
right.
not,
And now you can get away with English, pretty easily there now. How was it when you were growing up? Was it
well,
the
yeah,
same? Or?
you could, but they wanted you, like, if you were in the business world, you needed to speak French, and
Mm,
so that's just the way it was. So I said, I had no
mm.
one to blame but myself. But, I decided that if I wanted to get,
Now, did your father speak French?
no, no, or my mom.
No. So he's in I guess numbers. They don't care. Numbers are
Yeah. No. And then, well,
transposed across languages.
yeah, well, back in the day, like in the 60s and the early 70s, I mean, you could get away with just speaking English in the business world in Quebec.
Mm,
But that changed when the Separatist Party got into power in 1976. All the rules changed, and you had to speak French and stuff like that. So,
I see.
yeah,
That's when they required you to read.
yeah,
I
yeah,
see.
exactly.
Nice. Now, do you have siblings?
Older sister who still lives in, well, no, she just moved from Quebec to Ontario, just across the border. And I've got a brother who
Uh,
lives in Connecticut.
my sister lives in Connecticut, so it's a good state. Lots of Bostonites hanging out there. But
Well, they got lots of microbreweries in Connecticut, which I love. I love going
yes,
to Connecticut.
yes,
I really do. It's a great place to visit.
yeah, it's a nice summer kind of area. It's
Yeah.
nice, relaxing. It is the suburbs really of Boston, so
Yeah. Yeah.
that's the problem is you get the New York and Boston area that come out and drive up all the prices with their first, second, third, and fourth homes that they hop around to. So.
Yeah.
So then, are you the one that first left Quebec, or everyone kind of stayed
No,
in
my mom
Montreal area?
my mom left first. My parents were divorced in 79. She first came to Toronto, then she went to Florida, then she went to the Virgin Islands. She was a private nurse for
Was it because your dad wouldn't learn, French, or
yeah,
she just had enough?
yeah, no, yeah, well, she
Did she
was
run off with a French man? Oh,
no, not quite, but she was a private nurse for a millionairess in Virgin Islands, and
oh wow,
personal friends of hers were people like Fred Astaire and this kind
wow.
of stuff. It's a crazy story. And then my brother followed her down to the Virgin Islands, so he left a long time ago.
So now they separated for her to take this job, or she had this job, and that kind of
No,
created
they
some
they
holes
they
in the
divorced,
marriage.
and then they were already living apart, and then she
Gotcha.
she moved. Actually, it was somewhat similar in a way. She moved to Toronto, uh, and she went back to nursing school, and at the age of 40, she was living in residence at a nursing college.
Hmm.
And all the young kids were playing the toilet tricks on her because she didn't know what the hell was going on. But very proud of her that she went back and got her registered nurse
Wow.
RN. Yeah.
That's pretty crazy. I mean, she's literally double probably the age of the
Yeah.
average
Well,
student there,
exactly.
so
Yeah.
that's pretty nice to go back. Yeah. Now, how old were you when they separated?
Was 17.
17. Now, would that have an impact, or are you kind of better
Yeah.
better to separate, or
Yeah. Well, I mean, I guess how can it not? Like,
right?
but my mom says to this day, she still remembers. She was driving me to driving school, and she was saying that her and my dad were thinking of separating, and Are we going to be?
Strange conversation right before you're going to go to take a driving test.
I go crash
She's
a
like,
car.
hey, do great on your test. Don't worry. Don't be nervous. By the way, you may not see me again.
Yeah. Well, and that's my mom. There's lots of stories, but anyway, she said, so what do you think? Should we do this? And blah, blah, blah. And I said, look, if you're not happy,
She's asking your
Yeah.
opinion. Nice.
he said, if you're not happy, you shouldn't be together, because then nobody's going to be happy. I mean, I don't want you to separate.
Right.
And she says she still remembers that conversation.
Wow. Really? I mean, it seems like a lot of pressure for a 17-year-old to have to even give advice on, but you must have felt it at the home to be able to,
Yeah.
have that kind of an opinion.
Yeah. You knew things weren't going well.
Gotcha. Yeah. Well, let's skip ahead. Now you're 29. You're in Toronto. You're sleeping on a hardwood floor with no mattress.
Yeah.
So your mother raised you well.
Yeah.
You're now saying like, and I assume now, did you just move there on a adventure type of go, or
I had a couple of
what really drove you to Toronto?
Well, I had a couple of my best friends were here. So my best buddy John Combry, he passed away brain cancer a couple of years ago, unfortunately. But him and his wife were great friends of mine, so I was staying with them while setting up my apartment and looking for work. So, and I knew some other people here as well. And so that's why. And Toronto is the biggest city in Canada, and if you're hungry for a job, this is the place to come to. But there was a recession just when I came here, started looking, and I remember they had this. So I was applying for odd jobs. I was folding envelopes for a mutual fund company stuffing envelopes for a mutual fund company called Trimark. I was stuffing envelopes for a beer company called Labatt, and just anything I could do. And they had to sign for them.
Hopefully you weren't licking them in those days, right?
I can't remember. And then, then I got this. There was this ad in the window of this major video, which was eventually bought by Blockbuster. Permanent job, nights, minimum wage. It was like $7 an hour. And I would pop in every day and just say, just following up, if you made a decision. No, Paul, we're still, okay, don't want to bug you. So finally, when my manager was like 21, he said, Paul, I'm giving you the job because you're a go-getter. You deserve it.
You won't leave us alone.
Yeah, exactly. How we get rid of this?
Right.
So,
I like it.
No, but I loved that job.
And what was the job in? I mean, was it going to be sales?
So you're working, sometimes you're working behind the cash. Other times you're returning the VHS cassettes that people return to the store, putting them back on the shelf and making sure everything's in order.
So these are like video rentals.
Yeah, video rentals.
Like the Blockbuster.
Exactly. Yeah. And and they used to have like the top 10 rented movies. And I'd go through that list every week to see what people were, and I'd watch them, and assuming they're good movies, so then I could tell people, what it was about, if it was any good, because I took it very seriously. I wanted to have a positive impact, and that was my attitude when I moved to Toronto. Don't be a jerk. Don't, feel bad for yourself that you've been hard done by. No, get on with your life, and don't be a burden on anybody financially or emotionally. Just be reliable and happy. And boy, it's amazing the impact that can have on people. Yeah. So I loved it.
Nice. I mean, I've tried to explain to my kids we bought my son a Blockbuster t-shirt, and they really don't understand. They're like, so why would you'd go and rent a movie?
Yeah.
It's strange. It wasn't that long ago.
Wow.
But it's very hard to explain to this generation that, things aren't at the touch of a button. So.
Yeah, well, the progress, has been incredible. Because I remember, I think it was 1982 or something like that in Montreal, when the first video store actually opened. Like, boy, you can actually go and rent a movie. It was unheard of,
Now, was Blockbuster or Hollywood Video, or is this like a local one?
It would have been a local one. And we had Betamax. We didn't even have VHS.
Oh man, yeah.
Yeah, a long time ago.
Wow, the old betas.
Yeah.
So you went to Toronto, you had some fringe, you got a place, finally got a job. Were you able to buy a bed?
Pardon?
Hopefully that
Yeah.
was one of the top
But
things on your list.
but
Okay, nice.
only it was one of these buy now, pay later things. And,
Yes. We
so
still got those, unfortunately.
yeah, yeah. Well, thank God we did. Otherwise, I would still be sleeping on the floor.
Right.
And so, yeah, so well, it was a furniture store, and so they provided the financing, and so I got a hide a bed, and so
Mm. Oh,
luxury home.
nice. Yeah.
Yeah.
And I said this is probably a small studio, so it works great because you got a bed, a couch,
Oh,
and
exactly.
all in one.
Yeah, yeah,
Uh,
yes, yeah. All
nice,
self-contained.
nice. So that kind of set you there. Now, give us. I mean, did you go to school at this time, or what happened in Montreal? Because you ultimately went from there to running a fund with McKinsey, and
Yeah,
so
and
fill us in this, gap.
yeah, so yeah, well, and it's actually
Ah,
McKenzie, not no,
McKinsey did.
yeah, it's McKenzie, not
Oh, it's
McKinsey. McKinsey, the consultant,
Gotcha.
McKenzie Investments, it's a
Ah,
mutual fund company in Toronto.
McKinsey. It's in
And
Toronto.
yeah,
Gotcha.
so yeah,
Good to clarify. I did automatically see it.
yeah, no, so I mean, you're not the first, and no, I took an unconventional path, shall we say, through school. I was on a soccer scholarship in the early '80s out west for a
Uh,
year. It was like they were trying to put together like a pre-Olympic team for is it the '84 Olympics, I think. And so I was out there. I hardly had any courses. It was a disaster. It didn't make the team. Came back, kept missing registration for school, taking night courses, finally got into Concordia University full time. And so I finally
right.
graduated in 1987, and I graduated high school in 1979. So I was working in a Bavarian bakery all those years. And
Nice.
just saw my old boss this summer as well. It was fantastic.
Oh,
And boy, and those types of jobs, you start 6:30 in the morning, and my boss has already been there for an hour and a half. And I was usually
right.
over, and you're just, oh, and it's hotter than hell. Oven is the size of,
You did well in the Bavarian bakery. Then I'm sure he's just like that's the same as the owner. He's like, yeah, you got to have a few beers before bed.
yeah, exactly. But that's when you realize what hard work is. When you
Mm,
work for a business like that, he would take Christmas Day off. That was pretty much it. I don't know that he ever took a vacation because it's his own business.
mm, right.
Just hard, honest work. Yeah, it's amazing. And
Whereas a lot of them, we don't know in the U.S., 99.9% of businesses are these small businesses.
yeah,
So the large one that at most, they employ a lot of people. The largest employer are the small ones, but the small ones are the ones where, they're not making much. They're trying to make ends meet, and
yeah.
they are the ones, working, 16-hour days. So,
Well, I always say that politicians, they're well-meaning, but a lot of them don't have a clue what hard work is. Them sure they studied hard and all this
mm,
kind of stuff. And so I say that one of the requirements to be a politician is that you should have at some point in your life tried to start a business and see what it's
mm,
like. Risk your own capital, all the regulation and red tape you've got to go through to start up this business.
right.
I mean, it's mind-boggling. I mean, I used to own a brew pub, and
All right.
all the licenses, fees, and the things you got to do, and you know, and it's just like it grows over time. And I think they were all well intended at the time, but then you accumulate into this monster, which is hard to get anything done. You know?
Yeah, unfortunately, they get paid quite well in DC, but in Texas is somewhat similar to what you're talking about. They only make, I think it's about 15,000, and it's per biennium. So that's for 2 years, it's 15,000. So Texas has quite a few entrepreneurs that are involved in the legislature, and they fight to make sure it stays closed every other year. So
Wow.
there are some fun things in Texas, but
Yeah.
on the DC side, yes, it would be nice. Unfortunately, we have many who would be nice if a lot of our politicians had to have a job period before going and
Oh,
being
yeah.
elected, because that would give them a different perspective.
Yeah.
Whereas
Sure.
we have definitely crafted the art of, career politicians. So
Yeah.
there's, that fact, that's one of the issues right now is, 40% of our elected Congress, sits inside the retirement age of the 65 and over. So,
Right.
so to make any changes on a Medicare or Medicare, Medicaid, or Social Security is not an easy, feat. So,
Yeah.
so you were, what sparked you to get into ultimately McKinsey, fund? I mean, this is fund management. This is, tracking new investments and putting capital to work. I mean,
Yeah. Yeah.
what
So,
interested
well,
you
when I
there?
was in university in the mid 80s, I think it was 86 or something like that, when I realized I didn't know what I wanted to do. I was just taking courses, finance and this, I'll try this investment management. And then it was investing that it just hit me. It said, I have to analyze companies. I want to do research because it would
Mm,
combine a number of different skill sets. So you got to be good in math. I'm not a math genius by any means, but I always did well in math and I like it. And I like geography. I like psychology. So it would bring to the fore a lot of things that you would need to assess a business. Do I believe this management team? Am I giving them leading questions? Okay, let's do some forensic analysis of the accounting and stuff like that. So much fun, and I didn't know anything about the industry at the time. I thought this was going to be a great thing.
sounds like a blast. It's amazing.
Yeah, no, I just absolutely, I
I can
love.
just wait to hear about your honeymoon. It was, sit down, honey. Look
Yeah,
at these audit books.
no,
These are
exactly.
amazing.
Let's go
Look
through
at the
this.
fine
Let's
print.
go through the
Footnote
annual report.
72J.
Yeah, no, no, yeah, and it ended up being way more fun than I ever imagined it would be. And
Hmm.
yeah, so yeah, then when I moved to Toronto, I just started trying to, meander my way through learning about the industry because I was very naive when I was 29 about the structure of the industry. I didn't know anything. And because I was when I was in university, I would just read like history and philosophy and the classics and geography, nature. At that, I just had this thirst for knowledge, so I just did the bare minimum of schoolwork in university so I could get back to my books. And I always liken it to that Mark Twain quote: "I never let school interfere with my education." You know,
Yes, I love it.
and you need an education, of course, but but yeah, so I knew at that age when I was in my mid-20s, that's when I figured it out.
Gotcha. Now, you assume you found a wife, had some kids, or
Yeah,
what that kind of look like there?
yeah,
Nice.
um, so moved to Toronto, and I got a part-time or full-time 6-month job at this insurance company. I was working in the insurance company in the day and the video store at night, and both were like full-time pretty
Nice.
much jobs. Again, I loved it, but I still didn't have a lot of money. And so they had a small lunchroom, and I would eat on my own in this lunchroom every day and read the business section of the paper. And I was, having so much fun and eager and hungry. And but yeah, I ate alone every day because everyone else would go out and buy their lunch or go out to a restaurant or something. And anyways, one day, my to be future wife walks in to get some water from the water cooler. So we literally met at the water cooler. And the bottle is empty and it's too heavy for her to change it. I'm the only one there. "Oh, excuse me, could you help me change the water bottle?" "Yeah, sure, no problem." So changed the bottle. We started chatting. We started laughing. So we chatted for a few minutes, and then she leaves. And then the next day, she brought her lunch into the lunchroom. So that's how we met.
Ah, I see. I see.
But no, I say we were laughing a lot right from the start, and we're still laughing to this day. There's
Yes.
like lots of laughter and humor. She's amazing at puns, like the best I've ever met. Like so
So
clever.
she put together the political, I assume.
Oh, no, that was mine actually. That's probably
Uh,
lame by her standards, but yeah,
nice,
yeah.
nice. We're good now. I assume you're retired now.
Well, yes and no. So I left Mackenzie Investments 2.5 years ago. I'm 63 now. And, I left not because I didn't love my work. I still love my work, my team. But over the time, my great passion became communication and education. And I got so frustrated over the years witnessing what central banks were doing, distorting the price discovery mechanism of capital markets, bailing out Wall Street, driving at they sacrificed the Main Street economy on the altar of higher asset prices to disastrous consequences. And I was pissed off back in 07, even before the thing, because you could see what was coming. And so,
And by that, you're really meaning kind of moral hazard for investors that they now will continue to be more reckless because there could be a bailout instead of saying like, oh, we'd better be a little safer on what we do.
Well, exactly.
Because they won't bail us out. So.
No, exactly. And so then that became a main theme of my communication efforts in my quarterly reports to the clients whenever I was on stage making presentations. And it became very rewarding, empowering my clients. My clients would be stockbrokers and financial planners and stuff like that. And empowering them with truth, understanding, knowledge, give them analogies that they can use with their clients, helping them to make better decisions, investment decisions that are going to affect their clients' long-term financial health. I mean, this is real stuff here, really important work. And because if you get it wrong, you can have a real negative impact on somebody's future financial well-being. And that's not going to feel very good, So we're very careful investors. We lay it all out there. Here's what to expect from us in different market environments. These are the environments where we're not going to keep pace. We're going to be trailing. We'll still be growing, but we're not going to be keeping pace. So your clients are not going to like that. So here's what you can say to them, and stuff like that.
Right.
Most of the clients really appreciated that sort of approach. And
Gotcha.
And so then
open, easy to understand,
easy terminology. When I first started making presentations, all I was trying to do was impress people. Impress them with how smart I was, and because I thought, this is the best way to get their money. If they might not know what the hell I'm talking about, but if they think I'm smart, well, let's give them some anyways.
Right.
And then I stopped doing that because I started getting caught, and I started contradicting myself. Because I wasn't just focusing on the truth. I was focusing on trying to sound smart. And so, and then I said, I'm not doing that anymore. And so I'm just going to tell people the truth, whether they like it or not, whether it results in a sale or not. And that's it. And boy, it was, again, very empowering. It was very rewarding. And it's like that old saying, when you tell the truth, you never have to remember what you said. I just told the truth. And and so then a few people over the years were telling me that I should write a book about all this because I'm the thoughts that they hear anyways about why central banks are bad for the economy. Because most people in the industry would tell you central banks are good for the economy. They're not. They're good for stock markets, and they're good for driving housing prices higher, which we can talk about. House prices have no business increasing in price. It's a wealth redistribution effect. But I would say,
let's jump into some of those because you got a very interesting book. And when I first, I listened to an interview, and at first I thought, oh, this guy's a supply sider. But then I listened to a second interview, and I was like, well, maybe he's a Keynesian. So now I'm a little lost, actually, on how you would self-define yourself. But I wanted to get into a couple of things that I found interesting. I did go to school for a short time in Queens, so I somewhat have some insight into, I guess, Canadian terms And I do remember a professor who would use the word capital in a way I've never really understood it. And so, one, I want to find out, I mean, because how I would reference capital and coming from the venture capital world, capital is taking any resource and putting it to work in a way where you expect a return. So that's how I would just traditionally define capital. But I found you have somewhat of a nuance definition for capital. So I wanted to allow you some time to kind of break that down because I think it sets the stage for a lot of, what your book kind of has in it.
Yeah. Okay. Yeah. Thanks, Joe. So, yeah, one of the key issues is that a lot of people and a lot of policymakers don't understand the difference between money and capital. Capital is anything that you produce, a good or a service. So this podcast you produce, this is the capital you're producing and your listeners are consuming it. So capital, when you produce capital, can be consumed or it can be reinvested to produce more capital. So the example I like to give is, let's say you make a bike and I make a suit. We both created capital. There was no bike or suit in the economy, and now there's one of each. And then we exchange with each other. So now you've got my suit and I've got your bike. Now, importantly, this did not come at the expense of anybody else in the economy. We did not benefit at somebody else's expense. It was a mutual benefit situation, an exchange of the capital that we produce.
But isn't that the ultimate original definition of money as well? I mean, money is having something that somebody else will value, so you're willing to make an exchange. So, and thus, my suit for your bike, that would be the original money, right?
Well, let me get
to save foot leather, we converted to
a
different currency. Go ahead.
So if we just exchange the bike for the suit, that's direct exchange, barter system. And it's impossible to have an economy of any size with barter because you got millions of products all priced in terms of millions of other products. How many kitchen chairs does it cost for a flight to Florida, stuff like that. So no, we do indirect exchange through the medium of exchange, which is called money. Money itself has no inherent value. We simply use it to exchange all the capital that we're all producing in the economy, all the goods and services that we create. That's capital. And then we use money to exchange all that capital. So what we do, so let's say you make your bike and you sell it, let's say for $1,000. You have $1,000. What that represents is the capital that you've produced, that bike. Effectively, you have one bike stored up in that $1,000, right? Let's say you make 10 bikes, $1,000 each. You sell them, you got $10,000 in your bank account. Effectively, that's 10 bikes that you've got stored up in your bank account. Because when you use that money, your means of payment, what enabled you to go out and buy something with that money was the fact that you created capital and then you exchange it for that $10,000 of money.
Now, okay, so help me here, because how does capital differ than asset?
Well, I guess it depends on your definition, but I think any capital, I guess, could be an asset.
Gotcha. I end up often talking about crypto, and crypto, the example I constantly live is it an asset or is it a currency? Yeah. And so that's where it's like, if it's a currency, then it's an expensive currency to move around and nobody uses it as a currency. They now use it as a store of value. Yeah. Which is, if it's a store of value, then it's the opposite. It's trying not to be a currency. It wants to be an asset because it's trying to avoid being a currency so it can be a store of value. So that's where I compare those two. And when I get into the term of capital, I'm the derivation of this word capital is Latin for, cattle head. So it used to be, how they which
Okay.
is in Texas makes total sense. Any
Yeah.
Texan's
Yeah.
like, oh yeah, a head of cattle, that's how much.
Yeah.
Those are your assets.
Yeah. Yeah.
And
Yeah.
so putting it in those terms, and then deploying it, that's where I kind of juggle those. But it sounds like it's almost interchangeable to
I guess.
asset and capital the way you use it.
Yes, I think so. And in terms of Bitcoin, I'm not an expert on Bitcoin or anything like,
Who is? Who
well,
is,
yeah.
right?
But I mean, if it did become a money, an accepted medium of exchange, that's what it would be. And it would be used to exchange capital that was being created. So now going back to the $10,000 that you've got in your bank account, it's effectively storing up 10 of your bikes. And you're saving that money. You're going to go on a nice vacation at the end of the year. But before you get a chance to spend your $10,000, the central bank doubles the money supply. Now, when the central bank doubles the money supply, they print money or digitally create it out of thin air. They didn't have to create any capital to obtain that money. So that new money has no capital stored up in it. It obtains capital as soon as it comes into circulation by extracting capital from the rest of the money already in existence. So when they double the money supply, it takes 5 of the bikes from your $10,000 and puts it into the newly created money. And so when you look
Well, let's
bank statement.
if you can give us, because you have 3 chapters where you define money, and can you give us, just because before we jump into that analogy, can you break down a little bit of how you define money and its uses of money?
Yeah. So, I start off like a lot of people do when they talk about this, just talking about how money came into existence. And there's some controversy out there. Some people think that money was a creation of the government. And I don't believe that. I think I believe in the commodity.
Well, it is backed by the government, U.S. Treasury.
Yes, but that
granted, the dollar bills are now Federal Reserve backed.
Yeah, exactly. But it evolved naturally through the process of exchange, where people would start with barter, where you exchange a bike for a suit. And then it became very difficult when you got, once you get up to a certain amount of goods, it's impossible to do the calculation. And so people would start using one commodity to affect indirect exchange. And that it ended up being gold or silver, sometimes copper. And so if you went to the market with your bike and you wanted to buy, I don't know, a lawnmower, then, if you wanted to get the
how many
lawnmower,
lawnmowers equal one bike?
Yeah, but the lawnmower didn't want a bike, then you're screwed. So what you would do is then you'd sell your bike for gold.
Luckily, you got one of my suits that we traded from before. Every lawnmower needs a suit.
Yeah, so there you go. And so money solves a lot of the issues that barter would present. So first of all, you don't have to actually want what the other person makes, and they don't have to want what you make in order to make an exchange. So you do it through money.
So the medium of exchange.
Medium of exchange. And it's also what's called a unit of account. Everything's priced in money. You don't have to know that it's 1,500 kitchen chairs for a flight to Florida or something like that, and it knows all in money terms. And it's portable. You can put your money in your pocket, or now it's all digital. So there's all sorts of advantages that money has. For like the economy could not function without it. Money is super important, but not as important as capital, because you can have an economy with capital and no money. It wouldn't be much of one, but you would have no economy with
you can barter.
No capital, right?
Right.
So
with nothing to barter, you're not going to, have
no,
jobs,
exactly. And
so if that's money, and going back to your analogy where we have, I think you said 6 months worth of bikes or something, where I have $10,000 in my bank account, doesn't that already not equate to what I should be doing with money? I mean, why would I take money or why would I take my bikes, turn it to cash, and then just let it sit in an account? wouldn't I want to turn it to an asset almost? I mean, isn't that the
Well,
purpose is really to exchange that into an asset?
well, not if you want to go on a vacation at the end of the year, because then you're going to have to sell that asset to go on your vacation. So you want some liquid funds, for whatever reason. That's why there's money in the system.
Right.
And then you could put it to work while you're waiting. You might have a high interest savings account or something like that. And hopefully you can get 3 or 4%, which will just
Right.
barely offset the inflation if you believe the official inflation numbers.
So this is, and you're saying really the issue is basically the Fed could, add whatever it wants into the money supply. M2, it increases M2, whatever's in circulation, literally called money growth. And so that in effect is by definition, even though we think inflation is, the price of goods going up, inflation is actually increasing the money supply. So then if that's the case, I did read some stuff. I found it interesting. You seem to have to be a proponent of deflation. Can you help define that? Deflation to me is, I think of Japan for 30 years. Deflation is one of those scary things. I would say being economically trained in school, deflation's always the panic button. Like you do anything you can to avoid deflation just because, what ends up happening is people start hoarding money. They start hoarding everything and not wanting to spend it because they're all savvy. And they think, well, if I wait just a little while, price will go down and I'll get a better deal. So then you have everybody waiting and, self-fulfilling prophecy, prices go down. So it makes them wait even longer. And pretty soon you've gotten rid of all of the money in the economy that's moving around and you just sit on a whole bunch of assets. So please explain, I'd love to hear around this.
So all of that's a complete myth. When you have deflation, because of a contracting money supply, that is definitely not a good thing, and that should be avoided at all costs. Even though supply side economists, which I'm not, but I agree with a lot of stuff that they say, they would argue.
That's what I realized. I see now when I wrote you an email, I was like, oh, kindred spirits, supply siders. And then I listened to another one, I was like, oh, he's not a supply sider.
Well, I just reviewed 2 supply side economic books that are in my blog, so people can go. My blog is free, and I learned a lot just reading those 2 books. Anyways, in one of those books, they argue that the money supply contracting in the early 30s was justified because of the Smoot-Hawley tariffs, which resulted in a massive contraction in global trade and economic activity. So the money supply was contracting in line with economic activity, not vice versa. I don't know if that's true, but it kind of makes sense. I think even the Fed back then, said that that one of their roles was to increase or decrease the money supply based on economic activity. So anyway, deflation based on a falling money supply, I think it's safe to say is probably not a good thing and should be avoided. However, the natural state of an economy should be what's called good deflation. So when an economy is functioning properly, a free market capitalist system, again, like I was saying earlier, you should only benefit if you're benefiting somebody else. You're not supposed to be benefiting at the expense of somebody else like they do now with crony capitalism and bailouts and moral hazard, all that kind of jazz.
I mean, I agree with that, but isn't that interest? I mean, isn't interest the gain of the expense of someone else? I mean, granted, they're only going to take out a loan on interest because they plan to gain, but
yeah, no, it's not.
Isn't that what compound interest is?
It's not at the expense of somebody else because you are gaining the use of somebody's money for that time. So that's a fair exchange.
Gotcha.
I'm using their money, hopefully, to invest.
So really, by expense, you really mean like nobody's exploited. So
yes,
everybody is benefiting from it. Gotcha.
So the capital that you have, So the capital that you have should not be a result of someone out there having less capital. The capital you have should equate to cumulatively out there the capital that other people have that you produced. a win-win situation. That's the way it's supposed to be. Anyways, so in a free market capitalist system, when it's working properly, companies produce a product and they reinvest in their business to make that product even more efficiently, and they boost their profit margin. Competitors see growing profit margins in industries, and now they want to enter that industry and compete for some of that excess profitability. So when they enter that industry, they lower
Margins
the
go down.
prices to take market share from the incumbents. The incumbents say, holy shit, now I got to invest more and make my product more efficient. And so the costs keep coming down, like flat screen TVs. Over decades, it fell from like
You just brought back some bad
Yeah.
undergrad, macro econ classes. Price equals marginal costs.
Yeah. So they went from 3,000 to 300, and they're better, and the prices would be even cheaper if the Fed hadn't increased the money supply so much over the last 20 years. Anyways, so companies compete with each other, prices fall. So the ultimate beneficiary of all of this investment, innovation, R&D, and freedom of competition, which is really important, that the ultimate beneficiary is the consumer. And so you should have slowly declining prices. And so even if you're on a flat wage, every year in real terms, you're getting wealthier because your flat wage will buy more and more stuff. So in the last 30 years of the 1800s in the US, you had the money supply was growing at something like 4.5% or something like this per year from 67 to 97. But the productivity of the US, there was an explosion of productivity, stuff being produced, was growing much faster than that. So you had the amount of stuff in the economy growing faster than the money supply. And so you had good deflation for 30 years. That's the way it's supposed to work. But now
and really you're talking about real or real pricing of goods, where your real wages, excluding inflation, those should be increasing. So your wages are basically gaining on top of prices.
Exactly.
So not actual deflation, but wage gain, because it's definitely hard to bring wages down. Has, I think, been proven to be near impossible. The only way to do it is a massive unemployment.
Skill. But and it's not fun when wages are going down. But there is one example, 1921, the Great Depression of 1921, where wages did go down. And
now, was that 1929 or 1921?
No, 1921. It was Jim Grant wrote a book on it. It's called The Forgotten Depression. It's the depression that economists don't like to talk about because things were liquidated very quickly. They didn't stop wages from falling. And it was a very deep recession or depression, but it lasted maybe a year. And it sort of set the stage for the Roaring 20. Like, it was over very quickly.
Gotcha.
And so anyways, there's one term out there that some economists use called the paradox of thrift, which is sort of what you were alluding to earlier, where, if I don't spend my money, then I'm denying somebody else of an income. And that company is not going to do well, whatever, because I'm not buying their stuff. They have to lay people off, and they don't spend, and it all being spiraled down the toilet. No, it's never happened. And
this is the old George Bush request. Come on, spend your money. We owe a lot to DARPA.
Yeah, that's what they want you to do. They want you to spend your money because they judge themselves, and others judge them, with respect to whether or not they're doing a good job running the economy on GDP. And all GDP is final spending, consumption, for the most part. 2/3 of it is consumers. And a good whack is government, and 90% of what government spends is consumption, not investment. And so they think that consumption is good for the economy. No, that's the ultimate end point of the economy, of what we do. but you can't
And
have
by that,
that investment.
when you say they think it's good, I assume you're implying the way they measure economic growth, which is
Exactly.
GDP, which is
Exactly.
the expenditures, not the GNP, which would be income. Gotcha. Okay.
So yeah, so then
So if GDP goes up from our spending, then that must be good.
yeah, so if your GDP is going up, because you're putting productive, capital to productive use, creating more capital, which then you can use, and through the medium of exchange called money, spend more. That your spending is being funded by the capital being produced. That's really good. And GDP, which is a symptom of that, that would be really good. But if GDP is growing, not because more capital is being produced, but because more money is being borrowed or printed and spent, then that symptom of GDP is not a good sign of a healthy.
Well, you bring up the amount of money being borrowed and spent, and today, you're not American, but to those listeners who are American, congratulations. We now owe a record $38 trillion as of today, and 2025 had been the fastest growing increase in national debt. It's almost a trillion a year we owe in interest, and so that's where we are today. I know you've kind of retired. I assume your house is one of, it's a main asset you have as a retiree, having worked for a while. So with that, you have quite a bit to say about this wealth gap. So I'd love to hear kind of your take on the wealth gap. The average house in the United States has dropped, actually. It used to be about 470. It's about 420,000 now. Unbelievably, in my mind, it's just crazy, how real estate is that much.
Yeah.
I know you had mentioned if Krok was here, I looked it up for him, but he's not here. But per income, it's actually very expensive in Australia, and I think you would know a bit about Canada. So tell us a little bit about that, where you think everyone, this wealth gap, people have literally saved for their houses, and what this next generation is going to do. It's a lot. We talk about this a lot in our show, in the sense that there is a declining population. So here are a lot of young people who, houses are more expensive, and yet they're going to have a $38 trillion debt to have to pay off as well.
Yeah, you can't afford a home. And by the way, here's a nice debt obligation for you to pay off, for all the benefits that we took out. Our generation's been living beyond its means for years, just like the previous one did before us. But in terms of house prices, remember earlier I was talking about you created a bike, I created a suit. We both created capital. We exchange it, not at the expense of anybody else. I have capital because I created capital. Our house here in the suburb of Toronto is called Mississauga. We bought it in 2001. If we sold it today, we'd get about 4 times. We paid for it, about 2.5 in real term, 2.5 times in real terms. But what was our contribution to society to justify us making 4 times on our home? It was Zippo. We didn't do anything. We just happened to buy our home in 2001 when Greenspan and then Bernanke started in earnest their wealth effect policy of driving housing prices higher to create that wealth effect where people see their house going up, they extract equity from their home and spend it and drive that GDP number higher. And every year, more than once a year, Greenspan would talk about how much equity extraction was contributing to GDP growth, and they're all clapping and proud of themselves. This was a disaster. I mean, not just that they blew the whole housing market up and you had the greatest financial crisis since the 30s. It's that set in motion, not only in the States, but across developed economies or central banks like the Bank of Canada down in Australia. They're the 2 worst markets, by the way, where they took interest rates to ultra low levels, despite the fact that the economy was still growing, to drive asset prices higher. And so a house is not a productive asset. Like, my house is not producing 4 times the amount of widgets as it did back in 2001. It hasn't increased 4 times.
But aren't there assets like limitations? For example, I mean, there's one I imagine you put some work into your house. You probably didn't, you maintained it. And whether it's, the squeaky door your wife is screaming at you for,
Yeah.
or the floor, but you maintain it. But then isn't there also an asset holding where if there ends up being a lot more people and not enough homes, demand itself would create that to increase. So isn't that just buying an asset of which is a limited supply, and so you benefit on that,
Yeah.
growth in the economy itself?
If regulation prevents the supply from responding. Now, housing supply is not, it's a little bit inelastic, so it can take a little time to respond, but it does. And for a couple of decades here in Canada, the average home price to the average after-tax income bounced into 6 to 8 times. And Canada had pretty strong population growth. So despite the population growing, housing prices stayed in this it was range bound relative to income. And then as soon as you get to 01, it starts going like this. And now we're at 12 times. And a whole generation, pretty much, young Canadians, young Australians, and now increasingly in the US, young Americans are priced out of the housing market. They can't even dream of buying a home and starting a family. And if they do, they have to put it off for so many years. I mean, yes,
it's crazy because I do think like a starter home for $470,000 blows my mind. They went through stats on every state on, what kind of income you need to buy a home basically in each state. And almost all of them are over 100,000. And so that's mind boggling. But I did drop in to say, well, what is the comparison? How bad is it now compared? So I did look up 1950, home ownership rate was about 55%. Currently it's 65%. So more people actually own their home. It was higher. It's dropped since 2021. And I do remember you said Bernanke and Greenspan. I really credit more. It was Bill Clinton who really tried. The first one said, I want to get, we need to increase home ownership. So they really pushed policy. This was kind of the allowance of Freddie Mac and Freddie Mae to go and buy lots of mortgages, which followed around many administrations after that. So they tried to push home ownership quite a bit. And so there was that. And then in addition, in 1950 compared to now is housing percentage to income. So it was around 22 to 25% in 1950. Now it's about 30%. So it is slightly higher, but I have to break down. I look at the house, I'm like, well, a 1950s house compared to a house now, they aren't the same. No. In the 1950s, they were moderate homes. Now I have a refrigerator that for some reason needs the internet. My microwave, for some reason, if I'm on the other side of the world, I could turn it on and off. I don't know why I need any of that, but I've got it available. I have a 3-car garage, not a 2, a 3-car garage. And every house out there has an amazing car, not just a okay car. Cars now, you see, I mean, to find a 5-year-old car is almost non-existent here in Austin. They're crazy cars, and I cannot believe how expensive they are. People are paying $50,000 to $70,000 for a car. And so I do see there's so many gadgets and gizmos where if you were to compare a home in 1950s and a family in 1950s to one now, it does seem like we are living way outside of our means. So then it makes me wonder, like, are we, and we have home ownership that's increased, but is it that overall costs or the fact that we have a lot nicer homes, we have bigger homes, we have fancier cars. So if we were to say, cut all that out and say, all right, I'm going to go back to the old roll down window car, and the gear shift, which is probably costs more now to buy because they're so rare, and a small basic home, would that drop into that affordability of the 22 to 25% of income? And I wonder how that fits in.
No, that's not the issue. So, the fact that homes are and they are depreciating assets, but the fact that homes have become, some will tell you that they don't build homes like they used to, right? So, and they have gotten bigger. And recently, I think they started getting smaller again. But no, but this is progress. This is the way it's supposed to be. This, cars getting better. But it doesn't mean that you should be paying more for it. And if anything, in real terms, you should be paying less, that people are becoming wealthier every year. That's the way the system is supposed to work. And so with the TV example, that's exactly what happened, right? Where people are getting nicer and bigger TVs and they're paying less and less for it every year. It's not the same for services, but even services are impacted by this. And I talk about that in my book. The only reason people cannot afford homes, and by the way, this is going to be, I think, the first time in the modern era that the next generation is going to be worse off than the one that preceded it. And it's not because the assets became so much better that they cost so much more. No, it's because central banks took the financing cost down to zero to deliberately drive asset prices higher, assuming yes, we know this is going to benefit the top 1% inordinately, but eventually the benefits will trickle down to everybody else. Well, guess what? It didn't happen. And it's not going to happen. And theory would tell you that will not happen. There are some that benefit enormously from this.
Yeah, it's a really fun point. So I want to say, let's hit on that, where when you say, prices down to zero, that's really the interest rate. So
Interest rate, yes.
The Federal Reserve lowered interest rates, and they did this. This really started in 2008, around the financial or the real estate bust time, the Great Recession, as we're referring to it. And a lot of this, if we remember back then, this is George Bush was the first one. I think he started the DARPA program. President Obama was elected. He followed suit with two other programs. So this was which Biden and Trump put to shame when they came out with their COVID policies. But back then it was a lot. It was 800 billion, 900 billion. These were huge. And these were bailout asset. And then in addition, the Fed changed policy, and the Federal Reserve buys repurchase agreements. These are overnight agreements to kind of maintain that these are literally short-term bonds, and that's how they are able to control rates, through bond pricing. And for the first time, they expanded their balance sheet. They started buying everything. They were buying mortgage-backed securities. Oddly enough, they made a lot of money on those because they held them long enough, but they bailed out a market of which they then later sold. So they made money on it, but what happened is quantitative easing. Everyone was arguing, you're putting so much money into the economy. You have increased the money supply by such a large amount. I think it was like 3.5 trillion at the time, that this is going to end up in being hyperinflation. And so the argument to hyperinflation was they came out and said, hey, we have this great plan. It's called quantitative easing. And we're going to do quantitative easing, which means we're going to just sell off these assets nice and slow and ease everything back in. But one thing that doesn't really get mentioned, which I think you do well in the book, and I've heard you talk about it a couple of times, that really is noted, and that is what quantitative easing is. It really took assets, and if you had any asset, anyone who had an asset, that asset was going to appreciate. I would normally have said appreciate in value, but given the context of your, you're saying it didn't increase in capital. So let's say, but as far as the currency went, it was worth more currency.
Yeah,
exactly. The price increased. And however, if you had no assets, you were limited to owning your wages, and your wages didn't increase. So in other words, skip now 20 years to the future. And if you were born then, unfortunately, if you're not going to be inheriting any wealth, you still only have your current existing wages. Whereas someone who would have had something, and that now wealth of which has been growing as part of that quantitative easing, they will now benefit from the inheritance of that, which does create a massive wealth gap, because you have those who have no inheritance and those who have inheritance. And the quantitative easing literally protected anyone with an asset by allowing it to increase with the money supply. And so it creates such a unique dynamic that, I drew that out, but I wanted to kind of have that be a point that I wanted to bring up for you and see your thoughts on that.
So quantitative easing, was supposed to be like an emergency monetary measure. And then it became part of the standard toolkit because when they stopped QE1, they noticed the stock market started to roll over, not the economy, stock markets. So they came roaring back with QE2 to drive stock markets higher again. When that ended, it was rolling off again, and they came back with QE3, and now
we're still in the middle of it.
Yeah, and by the way, it was about asset prices. QE was about driving asset prices higher, rescuing Wall Street, driving housing prices higher. But the trouble is you quite rightly mentioned that the monetary policy used to operate with what was called a corridor system, and they would buy or sell assets and try and affect the interest rate that way, control it that way. And so with the amount of reserves in the system, but when they bought trillions of dollars of assets, at the same time, that created trillions of dollars of bank reserves. And at the time, it was a fractional reserve banking system. And so the banks technically could have used those trillions of dollars of new reserves to go pyramid more loans out. And if that had happened, that would have resulted in massive inflation. But it didn't result in inflation because the Fed changed the way they do things and the way they set interest rates. They started paying banks interest on excess reserves. So if you didn't lend out these reserves, you were still getting paid on them. And so the banks just sat on those reserves instead of increasing loans. And that's why you didn't have inflation. And then afterwards, they were sort of flying by the seat of their pants. I understand they're trying to save the financial system, but they're the ones who put it at risk in the first place. Regardless, they breed all these reserves, and then they kept increasing reserves to save the stock market. And now they realize that they have what's called like an abundance of reserves. So then they started calling it an abundant reserve monetary system. They called it that after the fact,
Right.
Yeah, it drives me nuts.
Fat pocket disease. Yeah.
And by the way, people say that the Fed was buying these assets from banks. They weren't. Banks were just conduits. They were buying the assets through banks from non-bank financial institutions, and the majority of them, this was as of 2013 anyways, were hedge funds. That's where they're buying the assets from.
Mm.
And the Fed, there's a paper on the Fed's website, and they talk exactly about this. They don't hide it, but.
Right. Yeah, no, they were buying them as you look to the Federal Reserve's balance sheet, it is amazing how many assets they have now. When I was going to school, we'd analyze the Fed's balance sheet often, and it's all repos really. So it was, a much smaller balance sheet, easy to kind of go through, and you see its mechanism. And now it's an entirely different beast, full of lots. It's a full portfolio of various assets. So it's quite interesting how it's changed. And they are still to this day trying to unwind many of them that came, because that was 2007. They hadn't finished their quantitative easing. And then we really had COVID, which kind of accelerated it. So, Paul, this has been great. Leave us with, some advice that you would say to young people where this wealth gap, exists. What can they do to kind of prepare for, the next generation? And, how should they think about that? And then also, let us know how people can find out more information about you.
Thanks, Joe. So the reason I wrote my book, because the only way I think that we are going to change this and how the next generation will benefit is if people are informed with respect to why they can't afford a home, why stock markets have been soaring, why the price discovery mechanism of capital markets has been distorted by central banks, which results in slower growth in productivity. There's a saying that the people always get the government that they deserve. Well, that's only true if the people actually understand what the hell's going on. And I don't think most people do. And I don't think most politicians for sure, don't understand. They think that, taking on debt and deficits are great for the economy. They're not. They're good for those who benefit from that, but it comes at the cost of everybody else. So it's only when the people actually understand what's going on and what's not okay, and that inflation is not good for the economy, 2% inflation is not good, that they will demand different actions from our policymakers. And our policymakers are not bad people. They want to do the right thing. But to do the right thing today would be political suicide because the people are not demanding it, because they all believe in the something for nothing myth that they've been fed by so many people for so long. So with understanding.
In fact, the U.S. government shut down for this very thing. Everybody's like, no, we have 38 trillion and it's shut down because they do not want to lose any benefits.
Well, actually, one thing I'll add, Joe, is that I listened to your podcast that you did recently on Social Security. And it was really good. And, there's something like $2.5 trillion in this reserve fund, the Social Security, and it's an asset.
Right. Yeah.
Right. But not really.
An asset, right?
It's not an investment because Social Security has lent that money to the government and the government has spent it. It's gone. Yep. So the only way the government can repay that $2.5 trillion is by taxing taxpayers in the future, the next generation. There's no asset there.
Yep.
Right? Anyway, so it's with understanding and again, and it's not a conspiracy theory, but with what's happened, I think it was good intentions that went bad, but now with reputations and egos, people.
Yeah, this has been too calm of a conversation. I got to say, Ethan missing here is hard. You would have enjoyed him. He's full of the conspiracy side. So
right?
It's been too calm of a conversation. We need an Ethan to lighten things up here, bringing all the conspiracies.
Well, it might be a conspiracy, but I don't think it is, but anyway, so I think that's just understanding, compassion. My book is not a book about retribution. It's a book about, here's what's happened. Here's why it went wrong. And if we don't stop it, it's going to get significantly worse, and it will not end well unless we decide to end it ourselves. And it will not be without pain. But as long as people understand, or believe at least, that we're all in this together, that it's not just me that's going to be the one suffering, I think people will want to do what's right, even though it's going to be easy. I really do believe. I got great faith in people. And and I think it'll happen. But the alternative is going to be really bad. I mean, look how divided the world is now. Look how divided the U.S. is in Canada. And I think it's in large part because of this. People know they're getting screwed. They know things aren't working as they should. They don't understand why. They can't connect the dots. So then it's natural that Republicans would blame Democrats and Democrats would blame Republicans, and up here is conservatives and liberals or whatever. And I'm down in the States a lot. We have a place in Florida. My mom lives down there. And I know a lot of Republicans and Democrats. They're all beautiful people, but a lot of them can't even talk to each other. How sad is that?
All right. It has become very toxic lately. Very toxic. So.
And most people believe in the same things. It's just on the edges that they differ, And anyway, so if people want to learn more about this, on my blog, it's a free blog. You can go to my website, which I think you mentioned, paddingtoncapitalmgmt.com or politicaleconomy.com. So it's PAUL, political economy. And so you can just put your email in there, sign up. You get a weekly email here on my rantings. And I've got lots of interviews like this on there. I got my book summary there. And my book is called Capital Offense, Why Some Benefit at Your Expense. And you can get that at Barnes & Noble or Amazon or Thrift Books. It's pretty much only available online. Like, it's a hard copy they'll send you. And there's also an ebook, I think, as well. And I'm doing an Audible version right now, recording it, which is not easy.
Oh, great.
Yeah.
Well, this has been great. It's Paul Mussen, and the
Oh,
book is Capital Offense. And I really appreciate you joining us today, Paul.
well,
So
yep.
definitely worth a read. Hope people check it out. So thanks
Thanks,
for joining
Joe.
us.
Yeah, it's been great to meet you. Great questions, by the way. Thank you.